Welcome to Supernatural Stocks on Moneyweb with your host, the Finance Ghost. This is your weekly fix of equity analysis designed for stock pickers. Whether local or international, you can expect a mix of news and my ideas about what I'm seeing in the markets. Turnarounds tend to grab our attention. Perhaps there's some kind of emotional tie involved, as we really want to see a household name save itself from the brink of disaster. On top of that, there is the obvious financial incentive. If you time it correctly, a turnaround can be one of the best investments you make. And for those who were unfortunate enough to be invested before things went wrong, a turnaround represents hope for a recovery. When assessing a turnaround, you need to figure out why the company broke in the first place. Are there problems that can be fixed, or do the issues run so deep that there is little hope of actually saving the place? An understanding of internal versus external factors is helpful here. Internal factors can be changed through management initiatives and strategies. External factors are, by their very nature, outside of the direct control of management. Although a great management team can still find ways to mitigate the pain, even the best executives cannot save a sinking ship in a violent storm. There is a tremendous quote from Warren Buffett on this topic. When management with a reputation for brilliance tackles a business with a reputation for bad economics, it is the reputation of the business that remains intact. Sound advice, as always, from the Oracle of Omaha. Businesses do sometimes go to zero, even large, listed ones, and sometimes they take good management teams with them. Tongaat Hewlett is certainly a good example of a business that has zeroed. Although internal issues arguably triggered the disaster, leading to allegations of fraud and related court cases and all sorts of things, we cannot ignore the fact that external issues in the sugar industry have also played a role in everything falling over there. In other cases, the external issues are problematic, but not terminal. PPC is a lovely example, with the cement company having to navigate a market where growth is extremely hard to come by. Despite this, the share price is up, wait for it, 274% over 5 years. If you bought this turnaround story, you are smiling all the way to the bank. But if you've been a shareholder for the past decade at PPC, you've lost roughly a third of your money. When a company falls into the turnaround bucket, it's because the longer-term holders are unfortunately deep in the red. So with PPC having just hosted a Capital Markets Day, it is worth digging into the progress in that story. There are elephants. There are many elephants. It feels like every known stock image of elephants was considered for this presentation. PPC's brand is built around elephants, and believe me, you will know about it in the Capital Markets Day deck. Africa's strongest animal is a powerful image, and the brand association makes perfect sense for an African cement business. When you add on the clever narrative around awakening the giant in this turnaround, then it gets even better. Here are some other catchphrases that they use. Rebuilding an icon. Redefining the future. You've got to hand it to the team at PPC. They do know how to put some exciting PR behind their strategy. Never, ever underestimate the value of storytelling in an equity turnaround. Of course, no amount of corporate fluff is going to help you if the numbers are weak. PPC has pulled off a remarkable financial recovery. And alongside the numbers, they've taken an approach to investor relations that the market really appreciates, with an early slide in the presentation promising straight talk and a candid approach. Although the South African economic picture is much better now than it has been before, investors are actually putting pressure on corporate teams to bring capital home rather than send it away, which is amazing. But the situation is not so rosy in areas like infrastructure investment. It is still cold outside. It is still really hard. PPC has been struggling in a tepid South African market. Where growth opportunities do emerge, imported alternatives are never far away. Across so many products, South Africa is a favorite dumping ground for cheap imports from other emerging markets. PPC's business faces the same issue being faced by so many others, ranging from Italtile, in tiles obviously, through to RCL Foods in sugar. In the slide deck, you'll find this statement. PPC's opportunities are internal. In other words, they are having to deliver better results despite a weak external market. If you can't rely on growth in volumes and market prices, then you have to unlock cost efficiencies in areas like coal and electricity consumption. From a culture perspective, this drives a focus on cost discipline. For investors, that's usually a good thing. One of the benefits of investing in a successful turnaround is that you do tend to put your money behind a management team that understands the importance of shareholder returns, not just vanity metrics like revenue or market share for the sake of it. You'll see plenty of commentary in the PPC slides on topics like capital allocation and optimizing return on investment or ROI. Other concepts that come through include quality revenue, disciplined pricing, and finding the right customer base and product mix. Again, when things are difficult out there, you're in an optimization mindset rather than a growth mindset. If the growth then comes, then the company is in an exceptional position to address it. This is part of the bull case. This is part of the upside optionality in a story like PPC. But let's not pretend otherwise. A turnaround was desperately needed. Things were bad at PPC. From FY17 to FY23, the compound annual growth rate, or CAGR, in their Ebitda was minus 10%. From peak to trough, Ebitda fell by 47%. It was not clear during the pandemic that PPC was going to emerge in one piece, with the banks firmly at the door and management focusing on negotiating funding packages and covenants that would give them the breathing room to just keep going. Thankfully, things have been much better in the past couple of years. Ebitda for the 10 months year-to-date in FY26 is 48% higher than in FY24. That is an extraordinary outcome. They are also higher than they were in FY17 at long last. Sure, there's nearly a decade of inflation in there, but the headwinds faced by PPC over that period far outweigh any benefits of inflation. In fact, when demand is weak, inflation works against you, not with you, because it creates cost pressures and hurts your margins. We also need to acknowledge that this is not just a South African story. Far from it, actually. Zimbabwe is a business built around US dollar revenue at PPC, with over 90% of cement sales in hard currency. With major changes made to the reporting lines and structures, management has far more visibility over this business than before. Here's a statistic that tells that story best. PPC Zimbabwe has paid $49 million in dividends in the past 2 years versus $33 million in the prior 10 years. That is incredible, let's face it. The lost decade issues at PPC clearly can be found in both South Africa and Zimbabwe, but the times have changed, with PPC Group's return on invested capital jumping from just 6.5% in FY24 to 13.4% for the first half of 2026. That is more than double. If Zimbabwe wasn't doing as well as it is now, then that would not have happened. A few years ago, many people believed that PPC was going to hit the concrete wall rather than build it. Today, PPC talks about being cash positive in both South Africa and Zimbabwe. Perhaps most impressively, they note that capital can be raised for investment in the South African business. This could not be more different to the position during the pandemic, when all we were reading about was covenants and groups of assets used for bank security. It's just so different now. The focus will now shift, though, from survival and stabilization through to capital allocation and growth. And this brings a different set of risks and opportunities. For investors, the hope is that PPC will make this transition without losing sight of the hard lessons they learnt in the past few years. They are still carrying fresh scars on their backs, so I doubt strongly that we will see unjustifiable risk-taking by this management team. Instead, the Capital Markets Day promises a focus on EBITDA margin and a very important step change that they expect in FY28 based on the new RK3 plant that they are building in the Western Cape. As turnarounds go, PPC has surely been one of the best examples on the local market. There's no such thing as an opportunity without risk, and these are merely my opinions on the stocks covered herein. Make sure that you do your own research, form your own views on the market when doing anything in your portfolio. Nothing in supernatural stocks should be taken as advice.